Hey guys, I'm Chris Gorman with Gorman Residential, and today we're going to be talking about something that maybe a lot of you won't be interested in, but we're going to talk about the federal funds interest rate. And I'm actually going to be doing a three-part series. So today, talking about the Fed, the next one will be about the 10-year Treasury, and the third and final one will be about the 30-year fixed rate mortgage rate, because all these things are tied together. And we're hearing a lot about the Fed, and I just want you to understand the basics of what that means. So stay tuned. All right, so what does it mean when they say the Fed is raising rates or the Fed is lowering rates? So what is the Fed? The Fed, when somebody says the Fed, that means the Federal Reserve, and the Federal Reserve is the part of the government that's responsible for controlling monetary policy. And the main thing that they control as it relates to monetary policy is the Federal Reserve target rate. That is the interest rate that they will set to inform commercial banks within the United States what to charge each other when they lend each other money. And so, as those rates go up and down, the commercial banks follow suit. So, in a scenario where at the end of any banking day, a commercial bank has an excess of funds on their books, they look to lend that money out to a different commercial bank that may have a shortfall, and they're going to charge an interest rate for that, even just one night's worth of interest. That rate is what the Federal Reserve target rate ultimately directly impacts. Now, everything else from there in terms of the United States economy and lending and the dynamics of those two things is a derivative of what that federal interest rate is. But that's the basic explanation of what it is and what it does. Uh, Obviously, it is a tool that they use to either strengthen or soften the economy. One example I can give you is if the economy is roaring and people are spending a lot of money, then demand is high for all products across all industries. Prices go up, right? Supply and demand, we've talked about this as it relates to real estate before. Well, same thing holds true in just about any market, any product that you buy. And if demand goes too high, prices soar, it becomes unsustainable. And if you think about basic needs like housing, food, clothing, water, utilities, energy, um, prices can only go so high before people just can't afford to pay. And they need these things to live. So runaway prices is a real problem. That's called inflation. And if it gets out of control, that could cripple a republic. And our government is a republic, and inflation is its number one enemy. So when inflation occurs, the Federal Reserve will raise rates. In other words, make it more expensive to borrow money, thereby softening the economy. When it's really, really cheap, when it's when the interest rates are really, really low and money flows more freely, that tends to stimulate the economy. And so usually you see really low interest rates in times that are tough. And to give you an example, the only two times, I'm pretty sure, fact check me on this, but I'm pretty sure the only two times in history that the Federal Reserve target rate was between 0 and 0.25% was first during the banking crisis of 2008, the mortgage crisis rather, and then second time was 2020 during the beginning of the pandemic. So not good times, right? When rates are really low, it's usually because we're in bad times and the government's trying to spur along the economy. And then when it strengthens, rates tend to go up, and things tighten. So the Federal Reserve interest rate does not directly impact the 30-year fixed rate mortgage. However, it's all related, of course. And so I'm going to talk to you over the next two segments about first the 10-year Treasury, and what that is, and then finally the 30-year fixed rate mortgage and how the three are all tied together. It's my job, I feel, as your real estate agent, to be your economist of choice. So while this topic might not interest you, it might not be the most exciting thing, it's important for me to know how the macroeconomic factors play with each other and ultimately impact the real estate market. One of the most common questions that we all get as real estate agents is, how's the market, or where's the market going? And without understanding these things, these macroeconomic factors, and how interest rates are integrated into the housing market and what impact they have, without understanding all that, it's really tough to give an educated answer, knowing that none of us have a crystal ball to be able to say for sure what's going to happen. But if we're going to take an educated guess, then we might as well get educated. So this is your opportunity to do that. If you have any questions about any of this, or you want to chat further about it, I love talking about this stuff. So feel free to reach out to me. You can do so at Chris@Gorman Residential, or 919-670-3005. Thanks for watching, and do me a favor and hit the like and subscribe button. That's something that I need to be doing more of. If you like the video, just press the button, and if you would, subscribe to the channel. That just helps me reach more people. So I appreciate it. Thanks so much. Bye-bye.